The entire investment industry is nothing but a scam. Please don't be fooled by charts like this. This is the S&P 500. It's going up over time, and that's what stockbrokers want you to know. But then there's also this chart. That's the gold price over time, and that's what precious metal dealers want you to see. But then we've also got this chart over here. If you're considering to buy a house, you might see a chart like this, right? House price is going up over time. So what's really going on? The reason why all of those charts are going up is not because stocks are a great investment in the economy, or gold is the hardest of the monies, or investing in your own house is the best option. The reason why they're going up is completely unrelated to all of this. Prices go up over time because US dollars enter circulation, and they enter at a fairly predictable rate of roughly 6.8% per annum. This compounds over 66 years. This means that the monetary base grew by 77%. That's really the inflation rate. The official inflation rate is roughly 3.1% per annum, but the money that's being printed, that grows at a rate of 6.8%. Now, how is this possible? How is it possible that the monetary base grows that much faster compared to the officially measured inflation rates? Now, there are several explanations, right? The first explanation is that simply the numbers for the CPI are manipulated. But another explanation is that maybe that's because of technological progress, right? When we measure consumer goods, of course, over time, we become more and more advanced at producing those consumer goods. It gets easier and easier to produce them. If you buy a television today, or if you bought a television 10 years ago, of course, nowadays you have better specs. Of course, for the same spec television, you will have to pay much less. And so it's the same for everything, right? It's easier today to produce that loaf of bread compared to, say, 100 years ago. With the CPI, we assume that there is no technological progress and that the money just devalues at the inflation rate. But really, the money devalues much faster. And that inflation rate is not fully visible in consumer goods because those are deflationary over time. They're easier to produce over time. The monetary debasement is really visible in everything else. It's not easier to produce over time, like land, for instance, or like companies, for example. This expansion of the monetary base means that the US dollar goes down like this. More than $300,000 in the year 1959 is now worth this over here. A bit over $4,000. Now, the main takeaway from this is that we should completely ignore US dollar valuations. The US dollar is the worst measuring stick for long-term performance because the US dollar just changes so quickly. What we actually should be looking at is relative performance. How is an asset class doing relative to the monetary base, for example? When does it outperform monetary debasement? When does it underperform? And where does it lie historically? Our target with investing is to generate more purchasing power. It's not necessarily just to escape monetary debasement. And if we do want to escape monetary debasement only, we still should time the market somewhat, that we don't buy the thing that's currently super hyped and super expensive. Check this out. This is the gold price relative to the US money supply. Without dividing by the money supply, gold just goes up all the time. But since the monetary supply expands over time, gold does not go up all the time. Rather the opposite. It just fluctuates around a potential equilibrium. And that's this dotted line over here. That's the average ratio of the gold price relative to the US money supply. And that chart implies that gold could easily fall by more than 30% from here. And then it would just be back at its equilibrium. It wouldn't even overshoot that equilibrium, which it did every single time when we went that direction. There is a momentum effect here as well. Now, this horizontal line, it also assumes that gold is able to completely offset monetary debasement. But I don't think gold is able to do that because we also have mining of gold. New gold enters the supply. The same way how the fiat money supply grows over time by 6.8%, we also have a growth rate of the gold supply. Thus, we should not expect that gold will always hover around this line. We should rather expect this line to be downward sloped somewhat. It should lose versus a hypothetical constant monetary base because of its mining. Now, how quickly does gold get mined? Roughly by 1.6% per annum. That's how quickly the gold stock grows historically. So yes, I do think that gold is currently overvalued and it's probably a bad idea to hold it over the next 5, maybe 10 years. That's not necessarily the story that the precious metals dealers want to tell you, but I think it's the most accurate story. Now, what about stocks? This is the S&P 500 relative to the US money supply. This here was .com. This here was the creation of Bitcoin. Here we had the crash of the global financial crisis. Since the creation of Bitcoin, the S&P 500 outperformed monetary debasement. Now we are at a very similar level to where we had been at the height of .com. If we assume that the S&P 500 long term just hovers around the equilibrium, it could fall by roughly 50% from here, a bit more than that. It's unclear whether or not stocks long term outperform debasement, at least in terms of prices, right? If you completely ignore dividends. We could also make the argument that maybe stocks long term outperform, but that outperformance is much weaker than people think. This is 50% over the course of 36 years. The volatility is the much more important part. This loss of purchasing power of 74% or this gain of purchasing power of 482%. It does matter where we buy in the cycle. This constant narrative that gets pushed that we should always just buy into the stock market irrespective of the price because long-term things go up. I don't subscribe to that. Yes, of course, getting out of fiat currency in general is a good thing, but getting into stocks at any valuation is not a good thing. We want to escape the fiat system with the thing that's currently cheap, not the thing that's currently expensive. That's a mistake that the vast majority of people do. And that's why the rich get richer, the average person stays average, because the rich people know what I'm saying here. They are not buying into gold when gold is expensive. They are not buying into the S&P 500 when that's expensive. They are reallocating to their portfolios depending on what's currently cheap versus expensive. There are diversified portfolios. Diversification makes sense, but we don't want to have a fixed allocation to every asset class independent of the valuation of that asset class. We want to hold less when we are expensive. We want to hold more when we are cheap. Now again, we don't know if the S&P 500 really long-term outperforms USM2 if we were to really drop those 50-something% to the long-term equilibrium. That would mean a price to earnings ratio of roughly 20. This is a very long-term chart. It starts in 1871. It shows how expensive are stocks currently relative to their earnings. We are at a very similar level compared to the .com bubble. And I don't think it's unreasonable to see this chart going back to 20, or at least going back to 30. I'm not calling for a crash here. All I'm saying is that stocks are clearly on a historical scale not cheap, and that they have at those kind of levels crashed before. And so it's unreasonable to think that a crash like this could not happen in the future again. I think there's definitely a case to be made that valuations are rather stretched now, especially in the AI space. And I'm not even saying that AI is useless. I'm using AI several hours every single day. I'm just saying that maybe the companies that are currently building out the infrastructure might not be able to monetize all of that. Very similar to what we had during .com, right? A lot of companies that invested in internet infrastructure, and then some companies made money from this. Amazon, for example. Others, the true winners, haven't even been born at the beginning of .com. Google, for example, was created after the crash of the .com bubble. Something similar could be happening again. Dare I say it, but maybe the Anthropics of this world could be the Alta Vistas, the Lycoses, or the AOLs of tomorrow. It's possible. We don't know the best monetization for artificial intelligence. Is it really selling tokens? Or will the token selling model at some point run out of steam because there's very good alternatives that are much cheaper coming from China? I don't have an answer to that, but what I'm saying is that there's clearly risk. And that risk might not be properly priced in. But this is not a video about predicting where the markets are going from here. This is rather a more fundamental video. What should we actually do with our capital? Number one learning is clearly we should not be in fiat currency, because fiat currency devalues extremely quickly. Much quicker than most people want you to believe. 6.8% I believe is the best long-term estimate. you need to beat at least a 6.8% hurdle rate. If you don't grow your wealth by that rate, you are falling behind. If you don't grow your income by that rate, you are falling behind. That does not mean it's impossible to beat that. This here is the Nasdaq 100 or technology stocks relative to the US money supply. Yes, this is .com, and yes, this is the global financial crisis. Still, over the years, technology stocks outperformed the monetary debasement. And let's work with the assumption that maybe we will see something similar to .com in the near future. Even then, technology stocks would have outperformed the monetary debasement. We don't know how far we could fall. Still, there's clearly some kind of gain over the decades. If you're willing to take enough risk and you're willing to wait for long enough, it is possible to make money. Most money is to be made when buying things when nobody wants to own them and to sell them when everybody talks about them. It's very reasonable to take the volatility seriously and to not just buy at any price, but to rather reconsider, is there maybe an alternative that I can buy into when valuations are currently high? And then the question becomes, what are those alternatives? If the S&P 500 is now expensive, also measured in the PE ratio, should we then get into tech stocks, especially given that they tend to be very high as well? I'm not so certain. Now, this is the Bitcoin strategy channel, and I know I might be biased here, but this here is the Bitcoin price relative to the US money supply. And that was also long-term a moneymaker. It did outperform monetary debasement. Less and less with every single cycle, so the outperformance is coming down. But even with the recent bust and subsequent boom, right, when we went from 69K to 16K to 120K, from top to top, we saw 71% outperformance versus the debasement. But is Bitcoin already cheap enough? So instead of comparing now with the monetary base, let's just compare asset classes against each other. So let's say the S&P 500 versus gold, both of them hovering around the monetary debasement. Let's also compare the Nasdaq 100 relative to Bitcoin, both of them long-term outperforming monetary debasement because of more risk. This is the S&P 500 relative to gold. We can make the argument that stocks are currently expensive relative to gold. In general, I think gold is expensive. And I also think stocks are expensive. But which one is more expensive? That's what this chart tries to answer. And the argument would be that stocks, if they come back to the equilibrium, would be underperforming gold by 35%. In other words, stocks will fall even more than gold. Unfortunately, this is just one way to look at the situation. It's not that easy, because while we did have sideways movements for a long time, this is roughly 100 years of data, we could also make the argument that we had outperformance of a very similar time period. So do we have long-term higher highs and higher lows, or do we just have trading around an equilibrium? It's not clear, but I do think that we can make the argument that stocks are unlikely extremely cheap versus gold right now. There's definitely some more way to sell off more than the gold market will. That's at least my judgment call on this data. Where I think the data is a bit more clear is technology stocks relative to Bitcoin. This is Bitcoin divided by the Nasdaq 100. The curved line is a support that connected the cycle bottoms quite well over time, quite precisely as well. And it tells a very clear story that Bitcoin right now is very cheap versus tech stocks. Now, we cannot just draw the support line, we could also draw a resistance line that then gives us the potential upside, and that's roughly 100% from here. Now, there's several ways how this could play out. It could mean that Bitcoin doubles from here and technology stays where it is. It could mean that Bitcoin stays where it is and then technology crashes by 50%. I don't know what's going to happen. All I know is that Bitcoin relative to tech stocks, as both being risk on assets, seems to be pretty cheap. Bitcoin has already seen the deleveraging and has already seen the sell-off. We can clearly not say the same for technology stocks. And that's in the end what it's all about. It's about opportunity costs. We have to consider what kind of asset is currently the best to invest in. And while I do think that Bitcoin still has some way to go down, it's still not below its realized price. You've probably seen this chart in prior videos on this channel. We tended to fall below that at the end of every bear market. It's currently at $53,000. I do think there's a good chance we fall below that. I still think, despite that bearish number, that Bitcoin is set up in a better way compared to technology stocks. I have written a short cheat sheet regarding how to navigate the cycles. And that cheat sheet is in the pinned comment down below. You can get this either via Telegram, so you can scan this code over here. Alternatively, you can also click on this button, or you enter your email address, then you'll get that cheat sheet sent directly to your email. It's completely free. No credit card is required. No payment is required. It's in the pinned comment down below. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.